People's Bank of China has announced a 0.5% cut on the reserve requirement ratio for all banks. The move takes effect on January the 6th and should free up around 800 billion yuan for lending to boost economic growth. The central bank also pledged more financial support for small and micro businesses and improvement on incentives for lending. So, will an expanding monetary policy be a dominant tool for the central bank this year? How will the economy react to this change and other factors such as the easing of China-U.S. tensions and the introduction of a legal digital currency? To discuss these issues and more, I'm very happy to be joined in the Beijing studio by Qu Qiang, Assistant Director of the International Monetary Institute at Renmin University of China. We'll also talk via satellite to Professor Qian Jun, Executive Dean of the Fan Hai International School of Finance at Fudan University, and Steve Keen, crowdfunded Professor of Economics on Patreon. That's our topic. This is a dialogue. I'm Yang Rui. Welcome to Dialogue, Professor Qu. What does the lower reserve requirement mean for the sustainability of the Chinese economy in the new year, the year of the rat?
I think this is actually good news. I think we should do that earlier because as you've probably heard about that in the whole world we're going through an economic downturn cycle. So which means the whole world is trying to loosen up its monetary policies. We're trying to inject more money into the market so we can provide more incentive for the business to grow. And the U.S. and the EU and Japan, they've been easing up their monetary policy for a long time. USA, the Fed Reserve, hiked up their interest rate for a very long time, and then they started to stop doing this right now. So the whole world is going on easing, but China is always on a high platform of the interest rate and the reserve ratio. So right now, I think China is under a lot of attention. What does that mean? If China has very high interest rate, and also China has a very high RRR, but in the other part of the world it's very low and very easing, so lots of money will flow into China and try to earn this non-risk earning on the interest spread, so which is bad for China. And China now try to loosen up monetary policies a little bit, so China can keep on the same policy cycle with other countries, which will easing up the pressures on Chinese monetary policies and also easing the pressure on the markets.
Thank you so much. Let me cross over to Professor Qiang, who's standing by in Shanghai via satellite. Hello, Professor Qiang. What do you make of the impact of this latest round of RRR cuts? I mean, this is the 8th of its kind since 1 year ago.
So the first thing is to notice that this is different from a direct interest rate cut. What this means is that banks, they don't need to pay as much to the central bank. They can have more to lend. Whether that translates into small business will have lower financing costs is still yet to be seen, because actually we know that Economics 101 says not all small businesses should get lending. Only those with a viable plan, with a viable project, should get lending. So I need to be cautious in telling people that this will directly translate to all the small businesses having a lower financing cost. That might not pan out. Because we still need to rely on the banks to make decisions on which projects of those businesses that they believe are viable projects and therefore they can lend. But at the same time, what this is good about is that this provides a lot of liquidity to the market. One thing that we should still watch very closely is that during the first half of 2020, there is still a lot of debt that's going to come due. This includes a lot of corporations' debt. It also includes local governments, for example, the Chento bonds. The fact that a lot of these bonds come due in the next few months means that these local governments or companies, they're looking for liquidity to refinance their debt. So this would definitely help the market in terms of at least there is ample liquidity out there to be used to repay this debt.
But I wonder if this kind of RRR cut will add to the local debt instead of help ease the tensions and concerns of local authorities when local revenue has become increasingly a big problem. Let me cross over to Steve King. Hello, Steve. What do you make of the impact of the triple R cuts at this moment, the eighth of its kind? Do you think, along with the reduction of taxes and fees for the small and medium-sized enterprises, the triple R cuts will help boost the morale and therefore enhance the sustainability of the Chinese economy in the new year? What are your thoughts?
I think it's completely wrong. This is based on the idea that the banks lend out reserves, which is taught in Economics 101. It's taught in economics textbooks, and it's been completely contradicted by central banks. Not so far the Central Bank of China, but the Bank of England, the Bundesbank, the Norwegian Central Bank. They all say the money multiplier is a false textbook model. And when I look at the model, what it basically says is a depositor puts money in the bank. There's one way to go about increasing the amount of reserves, or you reduce the reserve requirement, which is what China has done now. That is supposed to free up money which can be lent out, which I suppose is the basis of that $800 billion figure you gave, or 800 million, whatever it was, a short while ago. But in fact, if you look at the accounting that's involved in banks lending reserves, the only way that creates money is if all loans are literally in cash. You go to a bank and you ask for a loan of $1 million and they give you $1 million in $1 notes or renminbi notes. That does not happen. Banks put an entry in your deposit account, and if that's what they do, this process cannot create any more money. It's using a textbook approach to the real world when that textbook has already been shown to be wrong. So I think it'll have very little impact. It's more likely the tax changes and things like that will have the real impact. To me, it's a signal of the authorities being worried about a downturn in credit. That's really what it says, virtually nothing else of any real significance.
Dr. Chi, from a prudent monetary policy to a more proactive one at the level of the PBOC, do you think this will help reduce what we call systematic financial risks at the defining moment of, say, very serious concerns about the bubbles?
Oh yes, I'm glad that two colleagues just answered the question from a different angle. I totally agree with two of them. Actually, they're both right. For me, Central Bank of China is actually trying to view this situation in a very systematic way. We loosen up the triple R so we can have a potential amount of money, extra amount of money we can lend to the SMEs, the small and medium-sized enterprises. But on the other hand, the interest rate was not that lowered. So, which create a situation for the general society that we are having expectation that the monetary policy is going to be loosened up. But the actual interest rate is not that low. So the people who wants to use their money for the speculation actually cannot get the cheaper loan. So which give the banks a way to think about what the situation goes on. Just like the professor in Fudan University has just mentioned, we can only lend the money to the SMEs with a plan, with a solid business operation. But with the other people, with the other SMEs, we still have to stick to the principles. We cannot lend to them. So actually, we just give a potential for the banks to create the money based on the credit, because this is the foundation of the modern finance. But still, we're not losing up the whole tap. The water is not coming to the pond immediately. So this is actually doing the things in a very prudential way.
Thank you very much. Let me go back to Professor Chen from Fudan University. What does the triple R cut actually mean for individuals? I mean, Chinese consumers in the new year.
So if you look at the bank's lending portfolio, they lend to corporations, local governments, and also lend to individuals. When they lend to individuals, things like car loans and mortgage loans are very important. So again, as we have discussed, lowering this reserve ratio gives banks more room to make more lending, including lending to individuals and households. If you look at the performance of these loans over the last few years, especially recently, because as we discussed, as you correctly mentioned, they are local governments and they are sectors of the corporations. They have too much debt, so there is risk there. But on average, the performance of mortgage loans across all the large and middle-sized banks has been very good. So that's one sector I think banks can expand their lending to. But again, very importantly, it's up to the banks to make the call on what type of households and what type of loans they would like to lend. But certainly there is room for banks to do that. And again, that's also important in terms of stimulating the housing market at places that there's room for growth. So you can't say that the housing market everywhere there's bubble. That's not right. Certainly you have to be careful at the housing market overall. But there are cities where the housing demand, the growth in housing demand, is very healthy, and then banks can expand lending to the households.
One follow-up question for Professor Chen of Fudan University. Given the downward economic pressure and the increasing pressure of unemployment rate this year, and the number of university graduates is put at, say, 7 million in this new year. That's a huge burden for the central authorities and authorities at the local level. So what do you think of the purchase power? I mean, a lot of liquidity is to be projected into the capital market, and we're talking about the impact on individual consumers in the Chinese market. But given the adversity of these kinds, will the proactive monetary policy pay off? First of all, Professor Chen, and then King, I'd like to have your comment.
Again, I think at the end of the day, we need a balanced approach. We need a combination of different tools. Monetary policy is part of it. In fact, I believe last year the policy that made the most effect was the fiscal policy, especially the fact that taxes on corporations, especially tax and fees on small and medium enterprises, did come down last year, and that made a difference for these companies because their burden was partially relieved. So coming to this year, so again, I do think the approach of having a balanced portfolio of both monetary and fiscal policy is important. Monetary policy alone, as we talk about, including this lowering of the reserve ratio alone, would not do much benefit to the real economy. Now, come specifically to the point that you just raised, I would like to raise 2 points. One is, you are absolutely right. Consumption is now one of the most, if not the most important engine for growth in China. There are a lot of real sectors that have some sort of trouble. But if you look at consumption overall, it's still very strong. As illustrated by data, as example, on Double 11, if you look at Alibaba's platform, the growth from last year's data, Singles' Day data, the growth rate was lower, but there's still very healthy growth. So consumption will continue to drive Chinese economic growth, and that's what I think that what we discussed, that this freed up liquidity can boost consumption, is actually going to help. Finally, the college graduates, it's actually very important that if you look at the labor market, there are a lot of changes in the labor market. While old sectors are shrinking, there are a lot of new sectors are opening up. So I do believe, especially in services sector, so I do believe there are enough good jobs for these college graduates to have.
Thank you very much, Kim.
Again, this is going about the attempt to stimulate by changing monetary policy entirely the wrong way. If you wanted to increase lending, you'd increase the equity backing of the banks. You would not be increasing their reserves. Reserves are not part of their equity. This is one of the mistakes people make by having a non-accounting vision of how banks actually operate. Overall, if you want to stimulate the economy, it's far more effective to use fiscal policy. Reserves, to look at what happened in America when the financial crisis hit in 2008, Bernanke increased reserves by about $4 trillion. Now, that's an enormous amount of money, and they were worried about that causing massive amounts of inflation. In fact, lending declined for the next 2 or 3 years. So it had no impact at all. Now it has given them problems in trying to manage their excess reserves. So to me, it's just a policy based on textbook economics, which is wrong.
Thank you very much. Now, Dr. Chi, if you look at the bustling business and prosperity of most of the Chinese restaurants, you got a strong feeling, look, domestic consumption is robust, it's pretty strong. But given the unemployment rate as well as the bubbles, despite the increase in labor costs and pretty weak policy options in ensuring income redistribution for the middle class and for the low-income groups in particular, what do you think of purchase power in the context of an increase in the liquidity?
Well, I think in China we have a very different situation from the rest of the world. Well, China is a country, well, like many Eastern Asian countries, we have a strong habit of saving. So in China, we tend to use, for thousands of years, we try to save for the rainy days. We're not getting used to living, by debt. That enabled China to iron out a lot of fluctuations in economic terms.
What do you think of CPI, Consumer Price Index? There could be such a strong, dangerous haunting specters about inflation, right? If you have such a big amount of deposits at the banks, you run the risk of, having very strong inflation.
I don't think inflation is a problem. I think current inflation has basically solely been influenced by the price of the swine meat and the pork. And also the regional conflicts like in Iranian and American, their conflicts probably boost up the oil prices. But that's the only two reasons. And if we exempt that put that two factors aside, we'll find out most of the commodities price, most of the products price are falling. And the demands are shrinking because the populations are shrinking. We have aging problems in Japan and Korea, in Taiwan province, and also in mainland China, and also in Hong Kong. So, and also in most of the part of the world, like Europe. America is basically, they're trying to just hold up their heads above the water. That's it. So we don't have enough demand, which makes probably the whole economy is going to go into the deflation situation, even though we're seeing some little bit sign, the pseudo sign of inflation currently. But I don't think inflation is a problem. Deflation is a far more serious problem we're going to face.
Let me go back to Professor Chen from Fudan. Housing price always remains a major hallmark in our examination of the economic performance, be it in China or other parts of the world. Let's look at housing prices in China. It has hit a 5-year low and will probably even more so in the year 2020. Will a lower RRR lead to a lower mortgage rate, and how will the looser monetary policy influence the real estate market and housing prices? A question for both of you, Steve and Professor Chen.
Sure. First of all, housing is a big sector in terms of housing-related businesses do contribute a lot to the economy in China as in other countries. The housing sector also is very important for household wealth. So one thing important about the Chinese housing market is to note that China is a very large and regionally diverse country, much like the U.S. And that's very important. If you look at all the stats, housing prices increase relative to disposable household income increase, there is no national level bubble. That is, there are more cities where the housing prices growth is lower than disposable income growth. There are places where that's not the case, so there are places with bubble, and you need to be careful. So what the government's approach at the moment, to my understanding, is that clearly they do not want housing prices, especially in the first-tier cities, to grow very fast, right? Because that's going to potentially create bigger bubbles and bigger resource misallocation. But at the same time, as I said, housing market is very important for the economy. So if you look at a lot of these large and medium housing companies, real estate developers and associated companies, the last 2 years, it's pretty tough for them. One is, as you said, sales is down. The other thing is, if you look at their product chain, is very long. So it's very difficult. It takes a long time for them to get the cash flow back. And they are actually having lending problems. They are having cash problems. So I think it is in this regard that the release of the liquidity potentially can help them. Obviously, they still need to rely on the good assets they have to get a loan, right? That banks is not going to lower their lending standards when they lend to these real estate companies. So I think what's going to happen is in 2020, you will see some cities, the real estate market will rebound. But the prices will not go up too quickly, right? So because the government has very clearly said they're not going to let housing prices go up too quickly. But the danger is that on the other hand, these major cities, we do need some price support for the housing market, and it's important that these large real estate companies need to have improvement in their sales. So I do expect to see recoveries in some of these cities in China.
Thank you very much. Steve, with all of the policy restrictions still in place concerning buying of a second home or speculative behavior in the real estate market in China, what do you make of the increase in liquidity in the capital market and its impact on the housing prices? I'd like to have your comments, please.
Well, the real thing that drives housing prices is increasing the level of new mortgages. And this is empirical work I've done in America and other countries. So what's actually driving rising house prices is rising levels of new mortgages. And this is what led to the subprime crisis in America. It overinflates the economy. It becomes dependent upon debt to continue growing. And of course, China used private debt very heavily between 2010 and 2016, increasing its private debt level from about 100% of GDP to over 200%, which is the fastest rate of growth of private debt probably in human history. You do not want to get caught in a debt-dependent economy, particularly a private debt-dependent economy, and you don't want to become dependent upon rising house prices as a sign of prosperity. That is what's leading to social breakdown in the West at the moment, particularly America and the UK. So I see this as a dangerous tendency, and I'm glad to hear that the government is intent to stop house prices rising too quickly. A large rise in house prices can completely distort the economy, as we saw back in America during the subprime crisis.
Steve, you spoke of...
If I may interject.
Yes, go ahead.
You know, again, the debt level is high, but as I said, if you look at actual banks' lending portfolio, the best performing portfolio has been mortgage loans. So this is why, you know, if you want to lower leverage, it's true. You lower the leverage of local governments and corporations, including real estate companies, but the household debt level in China is not dangerously high. So that's why I think this mortgage market, certainly there's room for growth. Sorry.
Yes, we take issue with the financial risks. Steve, let me give you a follow-up question as to the ability by the Chinese government to manage the damage of the bursting bubbles in online financing. What do you think of, say, the prospects of having financial risks? Because you spoke of the subprime mortgage crisis in the United States and its contributions to the 2008 financial crisis. What lessons could China learn from Wall Street?
Well, what the Americans did in response to the subprime crisis pretty much ignored the people with mortgages and bailed the banks out, and did nothing to reverse the actual damage to the mainstream economy. It fixed up Wall Street instead. That's led to the social division caused by quantitative easing, which has massively increased the wealth of the rich and diminished that of the poor. It's the sort of social tensions you don't want to bring into your economy, and you don't want to have the effective failure of that policy either. It was enormously expensive huge amounts of money, $1 trillion a year going to the financial sector, maybe 100 or 200 billion a year turning up in the real economy. So that what the learn is you don't do that. A policy I've been arguing for a long time is much more effective, called quantitative easing for the people, where the government's capacity to create money, rather than given to the financial sector, is used to pay off the debts of the household sector and stimulate the economy directly that way with a far more effective bang for the buck. So I think if you want to look for an argument, Francis Coppola has recently published a paper called People's Quantitative Easing, and that should be what the central bank looks towards, not to the actual practice of the Federal Reserve and the European Central Bank and so on, which have been immensely socially divisive and have made it almost impossible to let house prices fall without causing an economic crisis.
What we have been discussing here actually leads to my review of the stimulus package that the Chinese government adopted that released 4 trillion RMB back in the year 2008 and the previous Chinese government. So given the poor track record of the alleged credibility of the private economy, as well as a lack of confidence at this moment of the downward economic pressure, my next question actually goes to Chi Chiang here in the Beijing studio. Now, we are talking about domestic consumption, and the aging population comes up as yet another major. Since we get old before we get rich, that's a hallmark of that sort of characterizes the Chinese economic performance. What does the RRR actually mean for the aging population? And aging population, on the one hand, is a huge opportunity. On the other hand, we're not ready yet, right?
Yeah. I think the RRR's effect on the aging problems actually have a very, very long conductive line. It wouldn't affect that situation very immediately, but it's going to affect us in the long term. For example, you know the aging industry is actually a very large industry, like the nursing home, the silver communities, the AI nurses. They're going to help the aging populations, and also there's a good opportunity for the consumptions of the aged people. But who is going to pay for that long-term investment? Because AI, if you want to build a viable robot, if you're going to build a very comfortable nursing home, this is something very new in China as well as in the whole world. Basically, our banking funds or the insurance companies. Insurance companies are building a lot of these things because they need long-term capitals and long-term loans with a low interest rate. So this cutting down of the RRR is actually one step ahead, helping this large funders, large investors in this area. So I think it is going to have a very positive effect on this problem.
I wonder if Professor Chen agrees with your counterpart here in Beijing about the aging population and aging and the industry for the aging population.
Sure. So this is an important trend that we need to pay attention to. So I think in this regard, there's a lot we can learn from Japan. Japan has dealt with a lot of these similar issues, including businesses, how do they deal with doing business with America. So in this regard, I would like to add one point is to say that in providing services to the aging population, the financial services industry is very important. Okay, Steve just mentioned that we should not just bail out of the financial firms. We should help the people. That's right. On the other side, there's an issue called moral hazard. Institutions can have moral hazard. Individuals can also have moral hazard. In the case of aging population, one segment of the financial services industry is very important is insurance industry. Okay, so we know that in China, basic insurance, including life insurance.
All gentlemen, thank you very much. We don't have much
great.
time for further discussion about the aging population and the lucrative industry for this large group in the Chinese society at large. But thank you everybody for your meaningful contribution of the ideas to dialogue on the latest projection of liquidity in the capital market. I'll see you next time. Goodbye.